Welcome back to the Deep Dive. Today we are focusing on a company that is, well, so pervasive in the American dining landscape that you've probably eaten at one of their locations or like 10 of them in the last year.
Oh, absolutely.
We are diving into Darden Restaurants, Inc., but this is not just a story about unlimited soup, salad, and breadsticks.
No, far from it. This is really a story about corporate strategy, operational warfare, and how a single seafood shack turned into the world's largest full-service restaurant company. I mean, if you think Darden is just the owner of Olive Garden, you really need to adjust your scale.
Absolutely. The size of this entity is just astounding. We're talking about a corporate behemoth that, as of 2024, operates 2,181 locations worldwide,
Worldwide.
employs over 191,000 people, and raked in $11.4 billion in revenue.
Just staggering numbers.
So our mission today is to use this detailed stack of sources we've got, articles on their history, strategy, deep dives, financial reports, to really figure out how they manage this evolution.
And we want to uncover the mechanism of that growth. You know, how did they bridge that gap between running these high-volume, cost-conscious, casual chains like Olive Garden and LongHorn Steakhouse, and then simultaneously acquiring and managing these ultra-premium fine dining powerhouses like the Capitol Grill and Ruth's Chris?
Right.
It requires two completely different corporate mentalities, and somehow Darden manages both.
Exactly. So we're going to trace this transformation, starting from a tiny frog in Georgia, moving through decades of trial and error under a food giant, all the way up to the intense boardroom battles that really define the company today.
Okay, so let's unpack this. The story begins with a truly classic American entrepreneurial spirit. I mean, it's all embodied by William Bill Darden. And this foundation, it predates modern casual dining by decades.
It's an incredible start. Darden opened his very first restaurant, the Green Frog, in Waycross, Georgia, all the way back in 1938.
Wow.
And the fact that he did this at the age of 19, I mean, that tells you everything you need to know about his drive.
He wasn't just opening a diner. He was learning the entire restaurant business from the ground up, right out of his teens. And this small operation, it really gave him the insight and the confidence to tackle a much bigger, much riskier concept 30 years later.
And that bigger concept was, of course, Red Lobster. Founded in 1968, Red Lobster Inns of America was launched in Lakeland, Florida. And this initial location strategy, it just reveals so much about Darden's core brilliance.
It really does. Lakeland, while it's in Florida, is distinctly inland. It is not a coastal city where, fresh seafood is an expectation.
Right, which seems completely counterintuitive.
Exactly. It was an absolutely genius strategic choice. If Darden could successfully launch a high-quality, high-volume seafood restaurant away from the coast, overcoming all the logistical challenges of supply and, consumer skepticism about freshness, he knew the concept was scalable nationally.
So it wasn't just a test of the menu. It was a proof of concept for the entire supply chain and the operational model.
Precisely. And the test passed with remarkable speed. The initial Red Lobster was lauded by diners and critics for its value and its quality. And within 2 years, by 1970, they had successfully expanded to 3 locations with 2 more already under construction.
So he proved the model was viable, but then he faced that classic hurdle of rapid growth.
Right, which is capital and infrastructure. A profitable company can still be resource limited if its ambition just completely outstrips its ability to build out distribution, management systems, and new locations all at the same time.
That's the key inflection point.
It is. Darden realized that to execute his vision of a national chain, he needed the massive scale and the financial resources of a corporate giant. So in 1970, he sold Red Lobster to General Mills.
The cereal company.
Yes, the company famous for Cheerios and Betty Crocker.
That seems like such an odd pairing on the surface, a seafood shack and a cereal company.
Yeah.
What did General Mills bring to the table besides, a massive checkbook?
Well, they brought standardization and institutional rigor. They didn't just write a check. They fundamentally changed the concept. They upgraded the format from what was an inexpensive, almost fast food-style seafood cellar into the casual dining and family fare model that we recognize today. They centralized the operation, established the company headquarters in Orlando, and most critically, they provided the logistical infrastructure that was just necessary for national scaling.
But they kept the original talent, which is so often crucial when a small company gets acquired like that.
They did, and that was smart. Darden stayed on initially as company manager and was later promoted to vice president of General Mills in 1975. And his key protege, Joseph R. Lee, who had been the first manager of that original Lakeland Red Lobster, he became president of the chain.
Wow.
And under the stable leadership and the, vast financial backing of General Mills, Red Lobster just exploded. It reached almost 400 locations by 1985. It's a textbook example of how corporate resources can enable a founder's genius.
Now, General Mills was clearly enjoying the profitability of the restaurant business, and they realized they could apply this large-scale, standardized approach to other dining concepts. And this led to a period of rapid and sometimes disastrous diversification.
Yes. The 1970s became this sort of throw it against the wall and see what sticks decade for General Mills. One of their earliest diversification ventures was the York Steakhouse chain.
York Steakhouse.
Yeah, this was an English-themed cafeteria-style concept focusing on steak and chops.
That sounds extremely specific and very much tied to a passing 70s trend.
Exactly. I mean, it just lacked the broad, standardized appeal that Red Lobster was beginning to achieve. The cafeteria format was waning in popularity, and the concept really struggled to scale efficiently. So consequently, the chain was mostly closed down by the end of the 1980s.
A costly miss.
A very costly miss, and it showed that simply having corporate backing isn't enough. The core concept has to be replicable and broad.
But the next concept they launched was anything but a miss. In fact, it became the foundation for the entire future of the corporation, the Olive Garden phenomenon.
Oh, yeah. Launched in Orlando in 1982, Olive Garden was General Mills' second massive success. It was positioned not as authentic Italian cuisine, and critics were, often quick to point out its culinary shortcomings,
Sure.
but as a highly standardized, family-friendly, and value-driven experience centered on this perceived sense of Italian generosity.
And that perception proved to be a goldmine. Its growth trajectory was just stunningly fast.
By 1989, General Mills had already opened over 145 Olive Garden restaurants. I mean, that made it the fastest growing unit in their entire restaurant portfolio at the time. Its commercial success quickly matched and sometimes even surpassed Red Lobster's per restaurant sales.
So what was the key?
The key insight here is that Olive Garden optimized for volume, consistency, and a comfortable atmosphere, which resonated powerfully with the American family market. That dominance remains today. It is the largest Italian-themed, full-service restaurant chain in the U.S.
But that focus on replicability and standardization, which they perfected with Red Lobster and Olive Garden, also led to one of their most spectacular, expensive failures.
China Coast.
China Coast.
Yeah.
China Coast was launched in 1990 with the ambition of creating a U.S. national casual dining chain focused on American Chinese cuisine. Management believed they could just apply the Olive Garden standardization model.
A cookie-cutter approach.
Exactly. A comfortable dining room, consistent menu, efficient supply chain, and just map it onto a different ethnic cuisine.
So why did Olive Garden succeed so profoundly, while China Coast ended up being, an unmitigated disaster?
There are a few key reasons, and they really highlight the complexity of the restaurant business.
Right.
First, unlike Italian-American food, American Chinese cuisine is highly regionalized.
Right.
What works in New York is completely different from what works in California. So standardizing a single American Chinese menu just proved impossible for national appeal.
Okay, that makes sense. And second, managing the supply chain and the specialized cooking techniques required for high-quality Asian cuisine in a centralized, standardized chain format was just significantly more complex than running the Red Lobster or Olive Garden models.
So they couldn't apply their General Mills uniformity DNA to this particular cuisine successfully.
Not at all. It expanded to 50 restaurants, but it just bled cash relentlessly, losing an estimated US $20 million. By the end of 1995, the venture was entirely shuttered.
Wow.
The locations were either closed or converted into Red Lobsters or Olive Gardens, so they basically became collateral damage in the pursuit of the next big chain. It was a harsh lesson in the limits of diversification.
By the mid-1990s, General Mills had two massive winners and enough failures to decide they were ready to exit the restaurant industry altogether.
Yes. In 1995, General Mills determined that the restaurant division was a distraction from their core consumer food products business, which was their primary focus. So they decided to execute a spin-off.
And for our listener, that just means they created a new, fully independent public company by distributing the shares of the restaurant chains to their existing General Mills shareholders.
Exactly. So if you own shares in Cheerios, you suddenly own shares in Olive Garden. And this new entity was named Darden Restaurants, Inc. in tribute to the founder, William Darden, who had passed away a year prior.
The market debut was a little shaky, though, Ruth.
It was. The shares began trading on a when-issued basis at $9.75. And for those who aren't steeped in market finance, when issued just means the shares are traded before the actual split is finalized.
Okay.
So when Darden became a fully separate entity on May 31st, 1995, its shares opened at $10.75, which is actually 17% below the market's initial expectation.
So the market wasn't immediately thrilled with this new standalone restaurant operator?
Not entirely, no, but confidence quickly built. I mean, Darden launched as a massive force. 1,250 restaurants across 49 states and 73 locations in Canada. This new company, born from the capital and management infrastructure of General Mills, now had to prove it could survive and grow entirely on its own.
So Darden is now independent, but inheriting a huge machine like that comes with huge responsibilities. They planned for 2 more chains almost immediately, signaling continued aggressive diversification, but the market hit them hard right out of the gate.
They faced immediate turbulence. While they launched their first post-spin-off concept, Bahama Breeze Caribbean Grill, in 1996, testing the waters with Caribbean food and drinks, the broader market for casual dining was just becoming oversaturated.
And that oversaturation led to a brutal 1997 restructuring. What did that look like on the ground?
Oh, it was painful. They were forced to close 48 poorly performing locations, and this resulted in a reported $91 million loss for the company. That kind of loss, so early in their independent life, sent a really clear message. The General Mills safety net was gone, and they had to be ruthlessly efficient with their portfolio.
But true to their corporate DNA, they showed resilience. They bounced back quickly, posting a $102 million profit by 1998, and that was driven primarily by critical makeovers and operational tightening at the core chains, Red Lobster and Olive Garden.
That recovery enabled them to go back to incubation, which brought us Smoky Bones BBQ Sports Bar in 1999.
Another themed concept.
Another highly specific themed concept, yeah. It was designed as a sports bar that served barbecue in a setting meant to evoke an Appalachian mountain lodge. It was a new attempt to capture a different slice of the casual dining market.
And then, in 2003, they started developing a concept that was almost diametrically opposed to the endless pasta bowls of Olive Garden, Seasons 52.
Seasons 52 was a very smart, forward-looking move. It was explicitly designed to target a growing demographic. Guests who wanted to indulge while still eating well. The entire menu was centered on lower-calorie options, and the atmosphere was slightly more refined.
That shows the management team was keenly aware of the evolving consumer moving beyond just simple volume to focus on perceived quality and health consciousness.
It shows they were using these smaller concepts to test higher price points and different customer demographics. They initially limited this chain to the Florida and Atlanta markets, keeping the risk contained while they refined the model.
This constant tinkering led to a major strategic pivot in 2007. They shifted from primarily organic growth-creating chains from scratch to external growth through massive acquisitions.
That was the defining moment of Darden 2.0. In January 2007, they announced they were actively seeking established chains, specifically those with around 100 locations or strong franchisor potential. They were looking to buy proven market share rather than spend years developing new concepts.
And they executed that goal with the enormous acquisition of Atlanta-based Rare Hospitality in August 2007, spending US $1.4 billion.
A huge deal.
What was the critical value Rare Hospitality brought to Darden?
2 things, fundamentally, LongHorn Steakhouse and the Capitol Grill. LongHorn gave Darden a second, massive, highly replicable, and very profitable steakhouse concept to compete directly with rivals like Texas Roadhouse.
But the Capitol Grill was the true game changer. It was high-end, classic fine dining.
Absolutely. The Capitol Grill instantly provided Darden with credibility in the luxury market. This single move led to the formal creation of the Specialty Restaurant Group, which initially included Capitol Grill, Bahama Breeze, and Seasons 52.
So they're building a new pillar.
Exactly. Darden was no longer just a casual dining company. They had successfully diversified their risk by entering the high-margin fine dining segment. This diversification was critical because fine dining often holds up better during minor economic downturns than mid-level casual dining.
And as they brought in the new concepts, they were also strategically cleaning house. The Smoky Bones experiment was ending right around this time.
That's right. As the specialty group was forming, Smoky Bones was identified as a concept that just didn't fit the new binary strategy. It wasn't high volume enough to be core casual, and it wasn't high-end enough to be specialty.
So it was in a no man's land.
Exactly. They sold the chain for $80 million, completing the transaction in January 2008. The portfolio was becoming tighter, more focused on those two pillars of growth.
That specialty restaurant group was clearly the focus for the next few years. We saw rapid internal growth and then more acquisitions.
Well, between 2010 and 2011, Seasons 52 proved its viability and expanded rapidly into 11 more states. And then, in October 2011, Darden reinforced its luxury portfolio by spending $59 million cash to acquire Eddie V's Prime Seafood and Wild Fish Seafood Grill, immediately slotting them into the high-margin specialty group.
They were systematically building a luxury defense against the inherent volatility of the casual market.
Precisely. They understood that the margins on a $100 steak and a glass of vintage wine at Eddie V's are far superior to the margins on unlimited breadsticks.
Yeah.
This period also saw Darden's international strategy solidify with a huge development agreement signed with the Americana Group of Kuwait for at least 60 locations across the Middle East for Red Lobster, Olive Garden, and LongHorn Steakhouse. This spread the operational and market risk globally.
And meanwhile, they were still running internal experiments back home, testing efficiency, notably with this co-location concept.
Yes, in 2011, Darden attempted a fascinating operational experiment, co-locating Olive Garden and Red Lobster in smaller markets. The hypothesis was that they could share back-of-house operations, the kitchen, preparation, inventory for efficiency, while maintaining separate storefronts and dining experiences.
Did it work?
Ultimately, no. The sources indicate these locations were later converted into standalone Olive Gardens. Managing the complexity of two distinct menus, two supply chains, and two sets of operational standards, even in a shared space, likely nixed any of the desired efficiency gains.
Right.
It just showed that complexity, even when you're pursuing synergy, can sometimes be more costly than simply running two parallel operations.
We fast forward to 2012, and Darden makes one last major acquisition before all the corporate drama begins. The Yard House deal.
They acquired Yard House, a 39-location chain at the time, for $585 million. Yard House brought a completely different demographic, younger, more urban, focused on craft beer and a dynamic bar scene. It reinforced the specialty group's identity, providing a high-volume yet unique concept that wasn't reliant on steak or traditional fine dining. By 2012, Darden was diversified, specialized, and appeared strategically impenetrable.
But as history shows us, perceived invincibility is often when the activist investors arrive.
This next phase is really the climax of the Darden story. They look sound externally, but internally, the core casual dining machine was showing rust, and the corporate center was vulnerable.
In late 2013, the alarm bells went off when the activist hedge fund Starboard Value took a significant stake in Darden. Now, for the listener who might be familiar with the term but not the practice, what exactly is an activist investor?
An activist investor is essentially a hedge fund that buys enough shares in a publicly traded company to gain influence, sometimes even board seats, with the explicit goal of forcing management to make changes they believe will boost shareholder value.
And these are often drastic changes.
Oh, they're often drastic, selling off assets, cutting costs, or even firing the CEO.
And Starboard's entry coincided with a massive internal fumble, didn't it?
It did. Darden management was already under enormous pressure because of a colossal failure. They had invested US $100 million into developing a new internal digital platform that was significantly over budget and at least a year behind schedule. This failure led to corporate layoffs and the departure of key executives. Management's credibility was shot.
And under that pressure, Darden made the fateful decision regarding their oldest brand.
In December 2013, citing stock investor pressure, Darden announced plans to sell or spin off Red Lobster. For the company's longtime employees and, the founder's legacy, this was massive. They were severing the brand that started it all.
And Starboard immediately saw this as a mistake.
Right.
And pushed back hard. They weren't against restructuring, but they felt Red Lobster was being undervalued.
Starboard argued that the management's proposed sale was just short-sighted. They presented a highly complex counter-proposal. They wanted Darden to split the company and spin off the valuable real estate portfolio, often through a sale-leaseback structure.
We need to unpack that for a moment. Why was the real estate so valuable, and what is a sale-leaseback?
So, many established chains like Red Lobster owned the land and the buildings for their restaurants outright. Starboard argued that this real estate was far more valuable than the operating business itself. A sale-leaseback means Darden would sell the land and buildings to a real estate investment trust, a separate entity, for a massive cash injection, and then immediately sign a long-term lease to continue operating the Red Lobster restaurants on that same property.
And that unlocks huge amounts of capital for shareholders.
Exactly. But management refused to explore this.
Darden management pressed ahead with the direct sale of the chain, clearly desperate to just finalize the matter.
And this is where the famous fire sale description originates. In May 2014, Darden sold Red Lobster to Golden Gate Capital for US $2.1 billion. Starboard and many other investors just sharply criticized this price, arguing it was a serious undervaluing of the brand and its assets, especially the underlying real estate. They felt management rushed the deal to stabilize their own positions.
And this controversy didn't end there. It became a legal and ethical headache regarding material misrepresentation.
That's the most damaging part. After the sale, a leaked document surfaced, allegedly prepared for potential buyers or lenders, that described Red Lobster's financial health and future prospects far more optimistically than Darden management had publicly stated when they were justifying the need to sell the struggling brand.
So publicly, they're arguing the chain is struggling and they need to offload it, but privately, they're showing potential buyers a rosy future.
That discrepancy led directly to a union pension fund filing a lawsuit, alleging material misrepresentation against the Darden board. The atmosphere of corporate distrust was just total. Management defended themselves, suggesting the private equity buyer might have embellished the documents, but the narrative was set. The Red Lobster sale was badly managed and likely undervalued.
With Red Lobster gone, Starboard had one final and perhaps most dramatic target: Olive Garden. This is where corporate strategy met the everyday consumer experience in a spectacularly embarrassing way.
This is the stuff of business legend. Starboard didn't just criticize, they assembled a full slate of directors ready to challenge and replace every single sitting board member.
Wow.
And to support this proxy fight, that is, the fight to win shareholder votes, they released the now infamous, colossal 294-slide presentation.
294 slides of corporate failure. That is an unbelievable level of detail for an activist investor. They weren't just attacking the CEO, they were attacking the menu.
And that detail was their most effective weapon. It showed that Starboard wasn't just analyzing spreadsheets. They had done deep operational research, proving how disconnected the Orlando corporate headquarters was from the actual customer experience. And they hit on specific, seemingly absurd minutiae that resonated with every single person who had ever eaten at an Olive Garden.
Let's start with the most famous moment, the breadstick issue.
The breadsticks. Starboard analyzed the wasteful practice of serving these huge baskets of their signature unlimited breadsticks at the start of the meal. The problem: most of those breadsticks sat, got cold, went stale, and were then tossed. This was a direct cause of food waste and a deterioration of the customer experience because they weren't getting a fresh product.
And what was Starboard's proposed clinical solution?
It was simple, yet brilliant in its cost-saving and quality-boosting efficiency. Serve one breadstick per customer, plus one extra for the table. Then, serve fresh ones immediately upon request. It reduced inventory costs, it maximized freshness, and it demonstrated operational discipline. It just showed the existing management was asleep at the wheel on fundamental details.
And then there's the pasta water revelation, which to me is the true aha moment of this entire deep dive.
The infamous pasta water. Starboard alleged that Olive Garden was not properly salting the water they used to boil their pasta. And this is a culinary basic: you salt the water for flavor.
And the reason given for this omission?
Reportedly, it was done to secure a slightly longer warranty on the expensive stainless steel cooking pots.
You cannot be serious.
Think about that trade-off for a moment. A multi-billion-dollar company was jeopardizing the flavor of its core product pasta and teaching its cooks bad habits, all to save a minor cost on pot maintenance. It just crystallized the failure of the previous management to prioritize the dining experience over corporate tie pinching.
Beyond the culinary crimes, Starboard also hit hard on corporate spending versus operational support.
Oh, yeah. They criticized lavish spending on the corporate headquarters and all the associated perks, while simultaneously revealing that the general managers, the people actually running the stores and dealing with the customers, were paid less than their peers at competitor chains. It just demonstrated a profound misalignment between corporate self-interest and supporting the front lines.
Darden management tried to fight back,
Right.
defending the breadsticks as a tradition of Italian generosity.
But the defense was too little, too late, and it felt highly defensive rather than strategic. The narrative of mismanagement and absurdity had taken hold. In October 2014, the situation came to a stunning conclusion.
Shareholders voted in what was a decisive moment of corporate history.
They voted to replace the entire board with Starboard's slate of directors. Replacing a full board is incredibly rare in corporate America. It demonstrated a complete loss of shareholder confidence and was widely labeled as an epic fail for the outgoing management team.
The CEO, Clarence Otis Jr., resigned. Gene Lee, who had been serving as interim CEO since the Starboard Revolt, was named the permanent CEO in early 2015. His mandate was clear: operational rigor, focused investment, and turning Olive Garden around using the very principles Starboard had championed.
The activist intervention completely, and I mean completely, reshaped Darden's trajectory. Following the Starboard-led coup d'etat, Darden emerged leaner, disciplined, and highly focused. The chaos of 2014 gave way to a renewed, disciplined strategy built on aggressive, high-value mergers and acquisitions.
And the first major action post-restructuring was the acquisition of Cheddar's Scratch Kitchen in 2017. They spent $780 million on that. What was the strategic appeal of Cheddar's?
Cheddar's fit perfectly into their updated casual dining strategy. It offered a middle ground, casual, affordable, high volume, but with a selling point of scratch cooking, which appeals to value-conscious consumers who still seek quality. It filled a critical niche between the Olive Garden LongHorn model and the specialty group.
And the market loved it.
Oh, the market approved. Darden shares grew nearly 9% on the announcement day, making them the biggest gainer on the S&P 500. It signaled investor confidence in the new, disciplined leadership.
That focus on quality and value at scale continued to pay off. But then in 2023, Darden shifted back to consolidating his luxury footprint.
That's where they acquired Ruth's Hospitality Group, Inc., the owner of Ruth's Chris Steakhouse, for $715 million in an all-cash transaction. This was a classic consolidation move. Darden already owned the Capitol Grill and Eddie V's. Adding Ruth's Chris instantly cemented their dominance in the fine dining steakhouse segment.
It gives them unparalleled pricing power.
And synergy opportunities in real estate, supply chain, and back-of-house operations in that specialized sector.
And they haven't slowed down. Their most recent recorded acquisition continues to fill out the casual dining map.
That's the acquisition of the Tex-Mex chain Chuy, which they completed in October 2024. This shows Darden's current strategy. They have their fine dining segment locked down, and now they are systematically adding proven, strong, regional casual dining chains to achieve truly comprehensive market coverage across all major food types: Italian, Tex-Mex, steak, seafood, and Caribbean.
Let's just review the sheer scale of the operation today, because the numbers confirm that the Starboard-imposed operational discipline has paid off handsomely. We're talking about a global footprint.
We are. Darden now operates 2,181 locations across the U.S., Canada, Mexico, Brazil, Costa Rica, El Salvador, and Panama. This is a vast, sophisticated machine. And their financial health in 2024 confirmed this success. $11.4 billion in revenue, leading to $1.31 billion in operating income and over $1 billion in net income.
And if we summarize the current 10 key brands in the portfolio, you clearly see that two-pillar strategy: casual volume versus specialty margin. That defines Darden today.
Absolutely. On the fine dining side, you have the high-margin, bespoke experiences: the Capitol Grill, Eddie V's Prime Seafood, and the newly integrated Ruth's Chris Steakhouse. These are premium brands where the average check is high and the experience is the product.
And then the high-volume engine of the casual dining machine: Olive Garden, LongHorn Steakhouse, Bahama Breeze, Seasons 52, Yard House, Cheddar's Scratch Kitchen, and Chuy. This portfolio is just built to be resilient, capable of catering to virtually any family or business dining need.
It's a meticulously balanced ecosystem. If the economy slows, customers might trade down from Ruth's Chris to LongHorn or Olive Garden, but Darden still captures that revenue. If the economy is booming, consumers move to their high-margin, fine dining experiences.
Finally, for a company this scale, we have to look at how they handle corporate responsibility, specifically concerning their massive supply chain and animal welfare commitments, which are complex and constantly scrutinized.
Right. And these policy commitments are where Darden directly intersects with public advocacy groups. Back in 2016, they made initial policies phasing out battery cage eggs in the U.S. by 2018 and committed to phasing out crated pork by 2025.
Which are significant logistical shifts for a company buying supplies in the millions of pounds.
Huge shifts. But those initial steps weren't enough to satisfy activist groups, were they?
No.
Because simply addressing housing doesn't solve the entire welfare picture. A coalition of environmental and animal welfare groups continued to criticize Darden for sourcing from intensive conditions that still involve practices like the routine use of antibiotics in animals.
And that isn't just an ethical issue. It's a major public health concern regarding antibiotic resistance.
Exactly. And that public health pressure led to a much more specific commitment in 2019 regarding chicken. Darden committed to stopping the sourcing of meat from chickens treated with medically important antibiotics by 2023. Implementing a commitment like this is a multi-million-dollar proposition. It requires working with thousands of different suppliers to change decades of farming practice, which impacts everything from feed costs to production stability.
And even their cage-free egg commitment, which they thought was settled, had to be expanded due to external pressure.
That's right. The Open Wing Alliance specifically called out Darden in 2022 for insufficient progress and for limiting their initial commitment only to domestic operations. This pressure forced Darden to expand its cage-free egg policy to include all international locations as well, pushing the deadline out to 2027. This continuous evolution shows that for a company like Darden, policy is often reactive. The speed and scope of change are driven by constant, organized external demands for accountability across their entire global footprint.
So we've gone from a single restaurant started by a 19-year-old through 5 decades of corporate consolidation to a global giant now wrestling with the ethical complexities of its supply chain, all while still managing the basics of salting pasta water.
The Darden story is an extraordinary journey. It's a complete masterclass in how corporate transformation works, how a founder's vision, when paired with the capital of General Mills, can achieve national scale. But it's also a demonstration of how a massive, successful corporation can become so bloated and complacent that it requires the brutal discipline of activist investors to realign its priorities.
The transformation was ultimately successful because Darden learned to manage 2 conflicting universes: the volume-driven, standardized operation of Olive Garden and the precision, high-touch luxury required at the Capitol Grill and Ruth's Chris. That ability to manage extreme cognitive dissonance is their core strength today.
But the truly unforgettable takeaway from this entire deep dive remains the starboard value fight. It demonstrated that corporate battles are not won just through high-level financial maneuvers, but often through the shocking revelation of micro-operational failures.
The idea that the future leadership of a multi-billion-dollar corporation could hinge on whether or not they were serving fresh breadsticks or whether they had prioritized a pot warranty over the flavor of their core product, it's profound. It's absurd, yet entirely real.
And it raises a vital question for you, the learner, to consider. Darden's failure was highly visible because their product is food. It's something everyone tastes and judges. But in a world of complex, information-overloaded corporations operating with razor-thin margins and massive scale, how many other major companies in tech, logistics, finance, or energy have multi-billion-dollar issues that could be solved simply by correcting a tiny, easily fixed but deeply ingrained operational or quality mistake? How many corporate giants are currently making decisions that jeopardize their core product for a marginal, short-term accounting gain?
A question that might make you look at your next plate of pasta with a bit more scrutiny. Thank you for joining us for the deep dive.